Business of Drag and Me with your host, the wonderful Braden. We'll talk about taxes, we'll talk about business, we'll talk about life. Spill the tea. See you there. Ow, whoa.
Hello there, Braden here, yet again, your favorite gay tax attorney helping drag professionals with business, finance, tax, and legal related topics. This is part 2 in our 12-part series where we're going through tax basics, legal fundamentals, all of the really important stuff that I think we all should know as freelancers and self-employed folks. Now, if you missed part 1 and the welcome video, I would go back and start at the welcome video. These are, when I say it's a 12-part series, I really mean it's like 12 lessons in a course or 12 chapters in a book. These are all actually, I'm modeling these videos off of the chapters in my book, Unfuck Your Biz. You can buy a copy if you would like to. So they are pretty cumulative, meaning if you just pop in at one of them without having watched the previous ones, you might get a little bit lost. Okay, so you might want to go back and watch those. In the last video, just a quick review if you already did watch it, we learned how we get to our net business income or how our business profit is calculated. We looked at the P&L, profit and loss statement. We had our revenue, our cost of goods, our gross profit, our expenses, and that's how we got to our business profit. Now today, we're going to be taking that business profit and seeing how it works with all of the other elements of our income, expenses, all of the juicy tax stuff in order to see how we actually get to a tax amount that we're gonna owe. I got props ready. I have a copy of my book here. If you join my Business of Drag Basics course, which is $50, you'll get, you can order a physical copy of this textbook or you get the PDF version. And I also still have my Matryoshka. We got all of our props. I got my copy. We are ready to rock and roll. So the first thing I want to tell you about is what I call, in my other program, I call it the Profit RX method because my program's called Profit RX. Teaching the same program here for you all. We're calling it Drag Basics, just giving it a little bit of a sexier brand for this specific audience. And the method is, it probably doesn't look straightforward. We'll pop it up on the screen, but it is straightforward once we go through all of these different sections. So we have our net business income to give you the overview. We have our net business income plus all other income. That's our total income. All right. Our total income that we care about for tax purposes, our taxable income, right? Well, we haven't gotten to taxable income yet. So we have total income minus any adjustments is our adjusted gross income. That's a term you've maybe heard before, even if you're not totally sure what it is. We're going to get to that. And then your adjusted gross income minus your standard or itemized deduction is your taxable income. And that's the amount on which we calculate your tax. So we're going to dive into each of these little subcategories and say what it is. Because at this point, you might be thinking, what the F, Braden? I have no idea what any of those words mean. I feel you. I didn't before I, took my income tax classes either. So I'm going to break it down. So last video, we got to net business income, right? P&L. Let's look at the P&L. Net profit, business owner profit equals net business income. Same thing. That's our net business income plus all of our other income. So what's our other income that we care about when it comes to tax purposes? Well, let's go back to our example with Trixie, right? In the last video, I gave a pie chart. I showed what Trixie's pie chart of income could look like. Now, I wasn't really sharing, the whole truth on that because the reality is some of Trixie's income might not really be part of her business. Like it might be, I'm not really sure how a motel would be taxed, if it's taxed the same as a business or if it's taxed as a rental property. It doesn't really matter. But let's say for this example that it's taxed more like a rental property, right? Like you buy a house, you rent it out, you Airbnb or whatever. That's another source of income. It's like probably separate from your business, okay? Let's say that all of this is happening the same year Trixie wins Drag Race. She has prize money. That is going to be a source of income as well that she has to pay tax on. Let's also assume, just for sake of this example, that she and her partner David are married. Okay, let's just say that they are for this example purposes, and he has his own income, right? Maybe he's self-employed, he has a job, I'm not totally sure, but that's household income, right? If they're married and they file joint, it's all going to go on the same tax return. These all are part of the same pie as far as their household income goes. So you add it all up, you get your total income, that's what we pay taxes on. So maybe you personally, you have a part-time or a full-time job, you work retail, you're a server, you have an office job, whatever. That's W-2 income that you get that becomes part of your total income. And we care about our total income because that's going to determine our tax bracket, which we'll get to in a moment. All right. So we have our total income, and then the IRS allows us to deduct from that some adjustments to get our adjusted gross income. Now, in the last video, I probably should have explained how deductions actually work and how they save us taxes. I did not do that really super thoroughly. So let's pause and do that now, and we'll use an example, okay? So I'm gonna try to make the math on this really easy. So let's assume that we have $100,000, $100,000, a clean six figures in business income. All right, $100,000 in business income. Let's say that's like our profit. So maybe our income's higher than that. We have some expenses, we're at $100,000. And now let's say, all right, you did a consultation with Braden. So we did our consultation and we managed to find $10,000 more in things that you should be classifying as expenses to deduct on your tax return. All right. So that took your profit from 100,000 to 90,000. Now let's assume that you're in the 20%, your effective tax rate is 20%, meaning that you pay 20% taxes on your profit. So 20% of 100,000 is $20,000, right? 20%, 100,000, $20,000. That would be your tax under this hypothetical scenario. Now let's think about it with that $10,000 deduction. Let me get out my handy phone calculator here, because 20% of 90,000 I can't do as well. You take a $10,000 deduction, so your profit is $90,000. Now you're only paying tax on 90,000. So 90,000 times 0.2 is $18,000. I should have been able to do that. Anyway, in short, you're in the 20% tax bracket. You spent $10,000. That saved you $2,000. So if we want to think about it in reverse order and do our math brain here, 20% of the $10,000 you spent resulted in tax savings. You spent $10,000, you saved $2,000. That's how a tax deduction works. The reason I like to explain this in painstaking detail is because a lot of people mistakenly think that a deduction equates to a dollar for dollar reduction in taxes, meaning they think, oh, it's December, I don't want to owe any taxes. I'm going to go spend money on a ton of shit. I'm going to go to Best Buy and buy a new computer. I'm going to go buy a ton of makeup. I'm going to go ham at Sephora, whatever. They spend all their money and then think, oh, great, I spent, $5,000. I'm going to save $5,000 in taxes. No, you spent $5,000 and you're probably going to save $1,000 in taxes, which is great, assuming two things. Assuming that those $5,000 and things that you bought were all things that you really truly needed, and that you have the $1,000 in the bank to pay the taxes. Because if you spend all your money to save on taxes, but you end up owing taxes and you don't have any money in the bank because you spent it all, not a good idea, right? You'd be better off usually saving the money. This is why we only want to spend on things in our business that we actually need, and then we take all the tax benefits we can for those things. I hope that makes sense. All right. Okay, let's go back now. We got to our total income, right? That's your business profit, your business net income, plus any other income that you have. And then we're going to minus adjustments. So adjustments is just another word for a type of deduction, but it's a personal deduction. So adjustment, deduction, they work the same. Okay, so we already explained how deductions work. Adjustments work the same way. I have this book out because I have in here the Schedule 1, which we talked about, right? That was one of our tax forms and our matryoshka. If we want to look at the Schedule 1, we'll pop it up on the screen in place of this book so you can see it. We have Part 2, adjustments to income. Educator expenses. So this is something you've probably seen people share about on social media. This is an adjustment you can take if you're a teacher and you have out-of-pocket costs for your job. So you're going to go and buy the crayons and the markers and everything for that, couple of students in your class whose parents maybe couldn't afford to buy that. Maybe they used it all. Maybe, I don't know, they broke all their crayons in half because they're little monsters, whatever reason. Okay, you need to go buy those. This is where teachers get to deduct that on their tax return. If we look down, health savings account deduction, moving expenses for members of the armed forces. We have self-employed qualified retirement plans, alimony paid, IRA deductions, student loan interest deductions. If you're paying student loans, the interest that you pay is an adjustment to income. These are all, I call these tax tools that we have in our tool belt in order to reduce our tax at the end of the day. And you might be wondering, all right, well, where do these tax tools come from? They all come from Congress. Okay, so when we all want to go on Twitter and complain about the different tax scenarios we have, how the wealthy pay a lot less in tax sometimes, depending on how they're taxed, but that could be a whole nother video. It all comes down to our tax code, which is given to us by Congress. They give the general rules, and then the regulations are written, and that is determinative on what we can deduct on our tax return. Okay, so these adjustments reduce our taxes. So let's say you have that $90,000 in business profit, and now you're going to deduct, maybe your full-time job is you are a teacher, and you have let's say $200 in deductible amounts for that. And let's say you pay $800 in student loan interest. That's probably high for 1 year, but I'm just doing that for easy math. That adds up to $1,000 in adjustments. So total income of that $90,000 minus $1,000 in adjustments gives you adjusted gross income of $89,000. That's how that works. The reason you've maybe heard of AGI or adjusted gross income before is because this is the number that's often used to qualify you for certain things. So I don't think they use AGI on like a credit card application, but in some other scenarios, like for a mortgage, things like that, they might look at your AGI. For certain benefits, like certain government programs to give financial assistance, they'll base it off of your AGI and how that compares to what they call like the poverty level standards. So if you're at like under this level, you might qualify. If you're over, you don't qualify. You get the picture. So that's our AGI. Now we take our AGI and we're going to minus another thing called the standard deduction or an itemized deduction in order to get our taxable income. Again, just another type of deduction. The math works the same way, but our standard deduction just works. This is what it is. The IRS says, hey, we want everyone to be able to just take another chunk of money off their taxable income. We want to give everyone a benefit because, yay, we're so generous. And in 2020, the amount was $12,200 for single individuals, and it was double that for married, filing, and joint folks. So $24,400. It's gone up a little bit. I think it increases just about every year due to inflation. But those are the amounts. So you get to lump that off. So if we had our $89,000, I'm just running with the same example. And let's say this is a single individual. Okay, so $89,000 minus our standard deduction of $12,200 is $76,800. Can we see that? $76,800 would then be our taxable income. Okay. So this person had presumably over $100,000 in business income because I already told you there were some expenses that were taken, but $76,800 is the amount that they would actually pay tax on. So we'd calculate the tax on that amount. Now I mentioned an itemized deduction earlier. These are all on the Schedule A. So let's pop that up on the screen. Whenever I say pop that up on the screen, you all probably know I'm talking to my editor. So we'll get that up there. Let's look at that. We have medical, dental expenses, taxes you've paid. That doesn't include federal income taxes. Interest, gifts to charity, casualty, theft, and losses. These are like adjustments, but the IRS just makes them like a little bit more of a pain in the ass, kind of. So these are additional deductions. And the way it works is you can add up all of these itemized deductions you have on the Schedule A. So yet another tax form, right? You can add them all up and you can deduct those. But the catch is, this is our catch, you only get to take the standard deduction, or you can take an itemized deduction. So if you've ever heard the term like I itemize or someone itemizes, it means they don't take the standard deduction, they itemize. Now, with the tax laws that passed in 2017, our standard deductions actually doubled. That's largely a good thing. We won't get into all of the other things that administration did because I could ramble for a while, but that was mostly a good thing. And all that really meant was that fewer people now are going to itemize their deductions because fewer people have enough itemized deductions that equate to or are larger than the doubled standard deduction. So typically, I'm just going to say typically, people are only going to end up itemizing if they own a home and are paying a lot of money in mortgage interest, because that's the big one. More often what I see is if you make, let's say, $250 in charitable contributions during the year. So maybe you donate $100 to a trans rights advocacy organization, $50 to Black Lives Matter, and then $100 to a local organization that you're really passionate about. They're all 501c3s. You get a $250 deduction. And let's say you have $1,000 in out-of-pocket medical expenses. Well, that's $1,250, a lot less than your standard deduction of $12,000 and change. Okay, so you'd stick with your standard deduction. Boy, we are getting into a lot of detail here, probably more than you bargained for when you stumbled onto YouTube, I would imagine, but hopefully it's really educational. That's my goal. My goal is always to educate, because why not? It's important to be well-informed citizens and to understand how our taxes work. So that's how we get to our taxable income. Okay, that is how we get to our taxable income. That is a recap of our Profit RX method. So now that we have our taxable income, let's talk about how the IRS actually calculates our taxes. We have tax brackets. You've probably seen them. Let's pop up an image of our tax brackets. We have these different tax rates, 10%, 12, 22, 24, 32, 35, 37. And these are our tax brackets. And this is the way I want you to think about these. I'm going to get out my Russian stacking dolls again, but we're going to look at them different in this analogy. Let me get those out of camera so they're not as distracting. So I want you to picture that these are buckets. So instead of stacking dolls, they're buckets. I'm just going to show you three to keep it kind of simple. So we have bucket number 1, number 2, and number 3. These are 3 buckets. And I want you to imagine you're a drag performer and you are doing a show for tips. Okay, you're doing a show for tips. You know, you collect all the dollar bills, the $5 bills, the 10s and 20s if people are feeling really generous. And you get so much money, you got to kind of toss it backstage and go finish your number to get all the rest of the tips. And what they're going to do is, in this hypothetical, they're going to put all of your cash in this bucket. This is bucket number 1. And if we look at our bracket again, let's pop up the bracket. We see that for whatever year we had this bracket made, the first bracket was for income from $0 to $9,876. So let's say we put all the money in this and it's just a wild night at the club and you get $5,000. Okay, so we put $5,000 in bucket number 1. And you're just going to carry that bucket to the next gig and you're going to put the rest of the money in there. And you know what? It's a pretty big bucket, but it fills up at $9,876. That's our first bracket. So this one's full. We're going to set it aside. And now money needs to start going into this one. I probably should have used the bigger one for this bracket, but that's okay. It's a bigger price range or dollar range. So you're going to put all of your money in this bucket until it gets to $40,125. That's our second bracket, right? Once it fills, you set him aside and you put money in bucket number 3 until you get to $85,525. I think you see where this pattern is going. These are our buckets. You're putting the money in there. And then at tax season, you're going to do your tax return. You're going to fill out all your forms, your Schedule C, and you're going to show your profits. And then I want you to imagine that Uncle Sam in the flesh comes to your house and you have all your buckets there with the cash in them. And he's going to take your taxes and he's going to say, I want you to give me 10% of all the money in bucket number 1. So 10% of the money in bucket number 1, he takes the cash out, good to go. I want you to give me 12% of all the money in bucket number 2. Okay, cool, he takes that. And I want you to give me 22% of all of the money in bucket number 3. That's how our tax brackets work. The money is siloed and you only pay that percentage of tax on the money in that bucket. The reason I explain this in painstaking detail is because a lot of people don't understand our tax brackets. I actually had a friend who is a fellow law student graduate of mine, and she told me, she said, my boss wants to give me a raise, but I don't want to take it because it's going to put me in the next tax bracket and I'm going to end up owing more. Basically, she thought she'd end up losing money on the deal because she thought, let's say she's going to go from the 12 to the 22% bracket. That's a big jump. She thought that then all of her income would be subject to 22% tax. And that if she only got a 10% raise and went from a 12% tax to a 22% tax, that would essentially cancel each other out. But as you see from our bucket analogy, that's not how that works. All right. So Uncle Sam took out 10, 12, and 22%. In reality, if we do all of the math and we determine, let's say on your $76,000, is that what it was? I lost it on my calculator. It doesn't matter. Let's say on your $76,000, you ended up paying 18% tax, which would be $13,680. That's what we call your effective tax rate. 18% is your effective tax rate. So 22% might be your tax bracket. That's what we call your marginal tax rate. Marginal tax rate, your tax bracket. Effective tax rate is the amount that you actually end up paying. That's what we really care about. Side note, if you remember, maybe you don't follow taxes as closely as I do, but AOC Congresswoman Alexandra Ocasio-Cortez proposed a 70% tax bracket a few years ago. And of course, people on the right went wild, but you know, a lot of people don't understand how these tax brackets work. And of course, a lot of the conservative politicians got on Twitter and said that she wants to take all of your money. But I believe, I'd have to go back and look, but I believe her proposed tax bracket was 70% on income over $10 million. So you'd be at 30% would be the highest rate underneath of that. And then only people over $10 million would be at 70%. So they're still getting to keep a lot of their money. This is why I think it's really important to understand tax brackets as well, just for life. Okay. So we get our taxable income and then we calculate our income tax. Now what? Well, we have tax credits. So one more tax tool in our tool belt. Tax credits is how I think a lot of people think tax deductions actually work. A tax credit is a dollar for dollar reduction in your taxes. So let's say you do all that math, you determine you have you owe taxes of $13,000. And let's say you get a credit, say you have a child, because that's a really easy one. Child tax credits are super common because a lot of people have children, obviously. You get a $2,000 credit, $2,000 child tax credit. That reduces your tax liability from $13,000 to $11,000. So I write in my book that if we're doing like the hierarchy here, credits are like the Regina George level popular. They're like the ones that everyone really, really likes. And then deductions are like the Karen or I'm forgetting the other character's name, the Gretchen, the Karen or the Gretchen. Super popular, but everyone loves the tax credit the most. That's how that works. So you use the credit, you get your remaining tax owed, and that's your federal income tax. That's the amount that you owe to the IRS based on all your household income. I know this was a very comprehensive video so far. We're still not done, but I'm walking you through all of this and, you know, what will hopefully be less than 30 minutes by the time we're done. So we have our federal income tax. I mentioned in the last video self-employment tax as well. So self-employment tax is a separate tax that we owe on self-employment income to pay our share of Medicare and Social Security. And that's a 15.3% tax up to certain income thresholds. After you hit those income thresholds, you only pay 2.9% tax, which is the portion for Medicare. So I'm going to walk you through this with an example from my book. All right, so let's get to our example. This comes from page 62 of my book. So Aaliyah is an online business manager. At the end of the year, she does her bookkeeping and finds the gross income of her business was $65,000. She had $15,000 in expenses. Pause and do the math on what Aaliyah's self-employment tax would be. Here's the answer. Business income is $65,000 less $15,000 in deductible business expenses, making net business income $50,000. If we calculate a 15.3% self-employment tax on that by multiplying the net business income by 0.153, the total is $7,650, which would be her self-employment tax. So if we were doing Aaliyah's like full tax scenario, we would calculate the income tax using those tax brackets, and then we would calculate self-employment tax. Those get added together. So that's 2 out of our 3 primary taxes we have to think about. The third one is state income tax. If you're in a state that has state income tax, we have to consider that. Now, the following states have no income tax: Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming have no income tax. And I know that Tennessee has like no income tax for the most part. I think New Hampshire falls in that category as well, but don't pack up your bags and move just yet, because there's a lot to consider in that kind of scenario. That's not what we're talking about. All right. If you have questions about that, you can book a consultation. Some states have no income tax. Other states have a flat income tax. So my home state of Indiana, where I'm originally from, has a flat tax. I believe it's like 3.2 something percent. So no tax brackets, no buckets, just a flat tax. Other states, the majority of states have tax brackets just like the IRS. The main thing I want you to know is that for the most part, our state taxes are going to be a lot less than our federal taxes, okay? And California will typically owe about, we can take our federal income tax and assume that our state income tax will be about a quarter of that. So if we end up owing $10,000 to the IRS, we'll probably owe $2,000 to $2,500 to the state of California. Oh, okay, deep breaths. Those were all of our types of taxes we're talking about here. What we're not talking about in this series really is sales tax. And that's a tax that we owe. I think we all understand that, right? If we go shopping, we go to Target, we go wherever, and we spend $100 on something and the cashier says, okay, you owe me $107. We know that $7 is for sales tax. That's entirely separate and apart from our income tax. If you sell a lot of product, like you sell a lot of merch, you might have to worry about sales tax. Probably not, because you're likely not over thresholds, but just keep in mind that that's separate. I bring that up because I just had a consultation yesterday where someone told me they were behind on taxes, and I spent 10 minutes explaining to them how to get caught up with the IRS, only to find out 10 minutes later that he was talking about behind on sales taxes, which is a whole separate thing. So that's all for this video. Looking forward, that's all for this episode, I should say, if you're listening on the podcast. Looking forward, I think this may have been our longest lesson. Maybe not. We have one more that might be pretty robust as well. But we will be ready for part 2. If you're kind of binge watching this all, feel free to go on to the next one. If it's already out, I'm going to be releasing these in a week-by-week format starting out. If you're watching it in the future, you can binge them all. But if you're really trying to digest all of this, maybe you pause, debrief, watch again, take some notes, do all of that kind of stuff. Let me know in the comments if you have any questions. If you're on YouTube, please subscribe to the channel. I would greatly appreciate it. That would be fantastic. If you're on the podcast app, also subscribe, like, leave a review, all that good stuff. Share with your friends. I'm Braden. Thanks again. When you're ready, I will see you in the next video.
Hi everyone, it's me, Rock and Sock from the cast of Season 12, RuPaul's Drag Race. Do you need help doing your taxes? Of course you do. You're stupid, but you're pretty. You might be a drag queen and you can do dips and splits and all of that other stuff. You can grab $1, $2, but are you paying Uncle Sam? If you don't know how, you need help, and that's why you need Business of Drag. That's right, you need Business of Drag. Taxes are a drag. Tune in for help from a pro. All right, all you drag performers out there, taxes are stressful. We all know tax season. Taxes are stressful, stress causes wrinkles, and filler is not deductible. Hire us for help. You need it. You really, really do. Hey everyone at home. Oh, there goes my titty. That is not deductible. Okay. Hey everybody, it's me, Rock'em Sock from the cast season. Hey everybody, it's me, Rock'em Sock from the cast season 12 of RuPaul's Drag Race, and I'm here to tell you that if you're stupid and pretty just like me, you might need help on your taxes, because taxes are a drag. But you need to tune in for help. Oh, motherfucker! God damn it, I got this wrong. Okay, one more time. Sorry. Hi everyone, it's me, welcome to the Cat Season 12 of RuPaul's Drag Race. You guys, if you're like me, you're beautiful, absolutely gorgeous, stunning. People run down the street just to get a look at you. But you're also insanely stupid and not good at doing things like math or handling your money. That's why Business of Drag is here. Taxes are a drag. Tune in for help from a pro. Might I add, taxes are stressful. Stress causes wrinkles and filler is not deductible. No deductee. Hire us for help. You need it. Business of Drag! Pay your taxes. Pay your taxes. Pay your taxes. Or Uncle Slam will do a split on your throat, metaphorically speaking. Do your taxes.